thank you very much for watching this State of the Market and State of the Economy 2019 presentation. I just want you to know that it's really a great honor for me to be on your financial team. So thank you very much for that honor and privilege. Okay, so let's get started. The S&P ended 2018 with a loss of about 6.2%. International markets were far worse. The average international fund lost 14%, did far worse. So that means that a diversified portfolio did worse than one that was just in the S&P, and that can happen. But getting back, okay, so the S&P lost money. The question is that a temporary blip on the screen? Is it a sign of worse things to come? Or is the beginning of 2019 a little bit more encouraging? Well, I'm going to talk at great length about that today, but no matter what, where you stand on things, I think you have to agree that it's a little bit strange out there. Interest rates went up last year. The government shut down. The British departure from the EU is being debated again. China and the United States are at loggerheads with respect to a trade agreement. And it seems like our elected officials are unable to govern. So there's a lot of chaotic forces all around, and it's no wonder that investors are spooked. So there's no way to predict the future, but I'm going to explain what I'm watching in 2019 so that you'll have a better understanding. And the basic theme of today is that there were three forces that hurt investors in 2018, and I believe that there's room for optimism that those same three forces will actually potentially be very beneficial for markets and investors this year. Okay, so the thing is, I'm going to go into detail on these three forces and some other things, and please take notes at the end of the, after you've seen it. Feel free to send me an email with any questions or comments. I'd welcome that. And the reason that I think this is so important today is that over the coming year, you're going to hear a lot of speculation from talking heads in the media and so forth about these three things. And, the journalists are great and wonderful, but they don't always understand the gray areas, and they can lead people to get agitated. So, and sometimes they really don't know what they're talking about. So I'm going to explain these things, what's going on in the economy, in a way that you'll be able to decipher what you should pay attention to, and when someone may be saying things they don't really know about. Okay, so let's get started. So here are the three things: interest rates, the trade agreement, and recession. These three were big worries in 2018. And I believe that, and we're going to talk about these three things in great detail. Now, there's possibly a fourth, which is unforeseen, which is political instability. But for now, and we'll talk a little bit about that toward the end as well. But for now, these are the top three forces we'll discuss in detail. Okay, so before we go into that, let's look at something a little bit even more important. And that is, 2018 was pretty scary. So if you ask yourself, were you a little anxious at some point during the year? I think most people would say yes, they were. And let's take a look at what was behind that fear. Well, first of all, obviously, the market dropped quite a bit, 20% from middle of September to Christmas Eve. And that's very scary. Now, if you look at the market for the entire year, excuse me, it ended with a 6% loss, 7% loss. And that's not good, but it's not a retirement killer. But what's easy to do is focus on this short-term, horrific, scary loss. And you project out from there rather than having a little bit longer-term perspective. And when you talk about longer-term perspective, if you look at the market over 3 years, market was up almost 50%. And that's, by the way, including the 20% drop at the end of 2018. So the bigger picture looks much better, but shorter term, it's scary. And if we focus on the shorter term, it can lead us to feeling pretty anxious. That's human. It's only human and a natural thing to do. But when you do that, it makes it a little bit more difficult to take advantage of longer term potential returns. And that can be expensive. And that can be a retirement killer. Now, to make matters worse, last year was the worst performance in 10 years. And last year was the most volatile year since 2009. So it wasn't all that bad, but it just felt really bad. Okay, so let's go on and look at the three forces that I talked about in a little bit more detail. Okay, first, trade with China. Trade wars hurt everyone. They hurt our economy because tariffs increase costs. It reduces demand. That reduces otherwise more jobs. It reduces employment, causes inflation, a lot of uncertainty. It's just not good for anybody. Both sides, China and the United States, have a lot to lose by this trade conflict continuing. Now, China has said recently that they're going to buy $1 trillion worth of American goods. They're going to reduce tariffs on American-made products, and they're going to take steps to safeguard intellectual property. So that's moving toward a solution. And, of course, there's a big gap between what people say they're going to do and what they actually do. But we can see that there's some movement, and we can also see there's tremendous benefit for both parties to compromise. Now, it could get worse before it gets better, and the results are unknown, but I'm very optimistic about the ultimate solution, because rationally they have so much more to gain by working this out than by not working it out. And I believe that what you're seeing is all negotiations. It's not really a trade war. It's negotiations around trade. So I'm optimistic because this is not an ideological conflict at this point. It's a business conflict. And if I'm right, it could be a huge boost for the stock market. And I believe that that's already helping the market, or hopes by investors that this will be resolved is already, giving the market a little bit of a lift. Interest rates, the second major force that will impact the market in 2019. Rates went up 4 times in 2018, and in the middle of last year, the Federal Reserve said they were going to raise rates 3 times in 2019. They walked that back to 2 times, but I'm not even sure that even that's going to happen. On the one hand, there is some inflation, right? Wages are moving up, and we have low unemployment. But on the other hand, the economy is slowing. When you look at the business and manufacturing numbers, the economy is slowing. And there's some other major developments that would reduce pressure to increase rates, in my opinion. Before we dive into that, I want you to, in fact, if you get nothing out of this presentation other than what I'm going to show you right now, it will be time well spent. I'm going to talk about what the Federal Reserve does. The Federal Reserve moves interest rates around, not just willy-nilly, but in order to do 3 things. Number 1, keep unemployment below 4%. Number 2, they want to make sure that we don't have super high inflation, definitely no deflation, and work against asset bubbles forming. And the third thing is the Fed wants to keep interest rates moderate. So with that in mind, let's take a look at the economy and see if there's really pressure to move rates up or down. Okay. Oops. Let's see. I think I moved ahead too far. Okay. So the first one is employment. So I said that the unemployment target was 4% or low, and the current unemployment rate is 3.9% as of today. I'm recording this 2 days before. Let's see. I'm recording today is the 26th, of January. So Unemployment is 3.9 and the target rate is 4%. So it's almost perfect. So there's no problem with moving interest rates to change inflation, to change unemployment. Next is price stability. Uh, the last interest rate increase was on December 19th, and it caused tremendous instability. The market dropped 10% for December. It was the worst December since 1931. So it caused instability, which is against the mandate. That's not their job. Their job is to create stability, the Federal Reserve. And a few days after that happened, the Federal Reserve Chairman, Jerome Powell, came out and said, okay, well, we know we said that we're going to keep raising rates, but that may not happen. We're going to be flexible and look and see what the facts are and what the data indicates, and we may change direction. Of course, once he said that, the stock market went up the most, over 1,000 points, the most it's ever gone up. So with respect to price stability, there's no reason to increase rates. It would create, instability. And we talked about, or I mentioned, asset bubbles. Okay. So right now, stocks are 10% below their average price. If you evaluate the stock market based on the earnings of the companies in the Standard & Poor's 500, and which is generally the way the market is, is looked at, whether or not it's expensive or cheap. So by that standard, the market is about 10% below its average. So there's no asset bubble, at least with stock prices, as far as stock prices are concerned. And let's talk about inflation. Target inflation is 2%. That's considered a healthy clip of inflation. Currently, inflation is 1.9%. Now, it's true that some things are going some things are moving up, like wages went up. That's true. But other forces are slowing down. For example, a big one is energy. In October of 2018, a barrel of oil was $75 a barrel, and currently it's $53 a barrel. So that's a huge chunk out of inflation. So if we take a look at all things considered, there's no inflationary reason to put interest rates up. There's no overemployment issue, and there's no asset bubble. Now, things could change, but I'd say right now the odds of having two interest rate increases are pretty low. Maybe there'll be one, maybe there'll be none, maybe there'll be a rate decrease. Of course, there's unforeseen circumstances we don't know, but based on what we're seeing now, I don't think that there's a high likelihood of two interest rate increases, and I think that would help the market, and I think that's already helping the market. So through looking at interest rates, we've also looked at really what's going on in the economy a little bit. And with that in mind, let's look at recession, because people were talking quite a bit about the fear of a recession, and that hurt the market. So let's see if that's really highly likely. Well, what is a recession? It's 2 quarters of negative growth. Now, in 2018, the GDP grew at 3.1%, and in 2019, the expectation is between 2.5 and 2.1. So the economy is slowing, absolutely, but it's not contracting. The growth isn't negative. Think of going for a walk. You're going for a walk and you're walking at a clip of 3.1 miles per hour. And then you get to a hill. So as you go up the hill, maybe you slow down a little bit, but you're not going backwards. So the economy is not contracting with, as we see it right now. Again, things could happen, things could change, but you've got to evaluate based on, what you're seeing right now and the way things are looking. The odds of a recession, the odds of having a contractionary quarters is pretty low. And there's other reasons why I'm not that worried about a recession. It's true that this expansion has lasted for 10 years. And it's the second longest expansion ever, and pretty soon it'll probably be the longest expansion ever. Some people think, okay, well that means for sure that we're, it's got to happen. The wheels of the bus are going to fall off. Well, not necessarily true. It's interesting to note that since the 60s, expansions have gotten longer. And here's the reason. In the 60s and 70s, companies didn't have the kind of technology, most notably inventory controls, that they do today. So companies back in the 60s and 70s, they would build big factories and churn out houses and apartment buildings and office space and washers and dryers and cars, big time. And then all of a sudden, they realize no one's buying their stuff. So then they have to lay off a bunch of people and slash prices and shutter their factories. So these big booms and busts were a result of, over expansion. Well, today, companies have a much better sort of finger on the pulse of what's going on with inventory control. So as a result of that, they regulate much sooner. They regulate what's going on, and they make changes to their production much quicker. So that's why expansions have gotten longer over time. Now, so expansions actually don't die of old age. Typically, recessions are brought about by asset bubbles and excesses. So for example, in 2000, we had the dot-com bubble that blew up. In 2007, there were the mortgages in the real estate market that was in a bubble and blew up. And in the past, it was automobiles and inventories and other things. And in the future, it will be something else. Right now, we're not seeing a huge asset bubble. So the growth we have now could continue as long as interest rates remain low and inflation remains low. The bottom line is the Budget Management Office, which is a government agency, expects or casts the odds of a recession at 24%. So it could happen, but the odds are not high. Now, let's look at it. I'm going to be negative Neal for a minute, and let's assume that there would be a recession. Let's see what happens. Well, this is a chart that shows since 1900, and it shows all kinds of expansions, contractions, recessions, you name it, wars, you name it. And we can see that the tendency is still up. Since 1960, there have been 617 months of expansion and 93 months of recession. So clearly the tendency is up. And even if the economy does go into a recession, does that mean we should avoid investing? Well, if we look at the facts, the ups and downs, regardless of that ups and downs, it really paid to invest. As much as your common sense tells you, to protect yourself, it really pays to ride it out in most cases. Now, the average bull market, the median bull market, saw an increase since the 1900s of 53% and lasted almost 3 years. And the average bear market saw a decrease of 25% with a length of 18 months on average. That's why, on average, over the long run, it's time in the market rather than timing the market. Okay, let's get back to you. So what should you do? I'll make one prediction. You know that I don't like to make predictions, but I will predict this: the market's going to be volatile, especially when you have news about China or interest rates or the recession, and markets are going to be rattled by political events. So how do you deal with volatility? Well, first is revisit your asset allocation. That means basically asset allocation is a jargon term for how much money you have in bonds versus stocks. And the more money you have in bonds, the less volatile it is compared to stocks. So one way to decrease volatility is to allocate more money toward fixed income or bonds. So think of this as buckets. So let's call the bond bucket. You have some money in the bond bucket, which is, let's say, call that the green bucket. And let's say some money in the stock bucket, and let's call that the orange. But see, there are other alternatives. There are more buckets, not just two. So you could move into, for example, dividend-paying stocks, which are more, generally speaking, and it's an oversimplification, but many dividend-paying stocks are less aggressive and less volatile compared to some growth stocks. So that's some kind of a compromise in between fixed income, and the stock market. You could have less volatile stocks. That's another alternative, and it's another reason why it's a good idea for us to talk and revisit. And speaking of talking and revisiting, the second way to protect yourself in a volatile market is to review, update, and stick with your plan. The worst thing you can do is get more aggressive when the market is good and more conservative when the market is bad. I know that it's a natural instinct, but it can really lead to disaster. This chart shows what happens if you miss just the top. Well, the first number, it assumes you invested $10,000 23 years ago, 22 years ago, and stayed invested. You can see that $10,000 grew to $40,000. And that's despite what happened in the market in the year 2000 and what happened in the market in 2007 and 8. And if you miss just the top 10 days during that whole 23-year period, your return goes down to by half. And if you miss the next 10 days, the top 20 days out of that whole 23-year period, your return goes way down to almost nothing. You almost get very, very little return over that whole 23-year period. And the thing is that statistically, the best days of the market come within 2 weeks of the worst days in the market. So that's why timing the market, while it's seductive, it's very risky. Now, you might be saying, you know what, hey, I don't have 20 years to grow the money. I want to get income. And I want income now. And I want income for the next 10, 20, 30 years. So if holding on to your money, if holding on to your portfolio grows the money faster or more effectively, then it stands to reason that holding on to your portfolio, as long as it's the right allocation, would create the most income, right? Now let's take a look at that. This is a very, very simplified, not optimistic, it's oversimplified. It shows you the income that you could earn on $100,000 invested over that period, what the income would be based on the return. So this would not work in reality. You'd have to have perfect 2020 foresight in order to predict, what you could do. So, but it illustrates the point. So, $100,000 invested. If you stayed invested during that period, you could have pulled out $6,250 a year in income. Versus, if you miss just the 10 best days, your income goes down by about half. And if you miss just the 20 best days out of that whole period, your income goes down significantly, down to $980. It's almost, not even, it's negligible. So this is why what I'm saying is that to time the market is actually risky when it comes to creating income. And I hope that makes sense. So don't get me wrong. I believe that there are times where it makes sense to be very conservative, but you should do that methodically. You should make that determination, as I do, methodically, not based on the emotions. Now, if you're riding through most of the ups and downs in the market, that means that there's going to be times where you have declines in your values. And but the reason that it makes sense to do that is for this chart that I'm showing you right here is because statistically you're going to create a lot more income if the odds are, you can't guarantee it, but the odds are that you'll have a lot more income by riding out those downturns in most cases. And I'm gonna show you a little bit more of that a little bit later. Okay. Now, so the bottom line on this is focus on your financial plan because it will help you think longer term rather than short term. I know that you know that the market goes up and down. But it's one thing to know it in your mind, and the other thing is to be able to embrace that when the market is going down. I know it's much harder, but nonetheless, for your long-term success, it's much better to remain focused on your long-term plan, which will help you ride through these market gyrations. Okay, and another way to deal with volatility is talk to me. This will help you get through changing times. If the market is changing or your own situation is changing, give me a call. One client needed $80,000. This was in the beginning of last year. She needed $80,000 because that was going to be the tuition to send her daughter to college for the next 2 years. And I said, hey, let's pull that money out right now. Did I say that because I knew the market was going to go down? No. I said it because I knew she needed the money and she couldn't take any risk. So that turned out to be good because then the client felt at ease and she had the money and she took care of her obligations. And it was also a win for us because that's our goal, is to help our clients, achieve their goals without worrying about it. Another client at the end of December was very upset about them, understandably, like a lot of you were. Market had dropped significantly. Didn't like what was going on in other aspects of our economy and in our country. And he wanted to go to all cash, basically at the very worst time. Now, I didn't know the market was going to rebound by, 15% in the next 2-3 weeks. But my suggestion was to hold on and reevaluate after the first of the year. Of course, by then, again, that's no guarantee of the future, just worked out. The market started rebounding and things seemed to be a little less dire. So that worked out pretty good. So the reason it worked out, and it was a win for the client, mostly because he called me and told me what was going on so we could discuss it. And I invite you to do the same thing. Now, bonus idea, shut off your TV or media, whatever it is. I mean, we turn to the media and the internet to try to make sense of the world we live in. But unfortunately, that's not the way it works. Excuse me. The media, their job is not to help us make sense of things, but to sell advertising. And they only do that if they get our attention. They get our attention through bombastic and over-exaggerated headlines causing us fear and worry. So one of my clients was very upset about it. And again, this idea of shutting off your TV and the computer wasn't my idea. This was a client. He was very upset, and his wife suggested that he shut off the computer and go outside and do some gardening or go for a walk. And he did. And he told me that really helped. So that might be something that you could take advantage of as well. Benjamin Graham, if you're not familiar with him, he was Warren Buffett's mentor and professor, and Warren Buffett credits Benjamin Graham as the reason why he was so successful. And he said that most investors' worst enemy is likely to be themselves. And you can avoid that problem by reviewing your plan and consulting with me when it's appropriate, when things are on your mind. Don't be shy about calling me on the phone and talking things through. So what should you do? I just want to make sure I didn't skip anything. Right. Okay. So what should you do now? Well, if you have many years before you retire, these ups and downs really don't matter. In most cases, they're just not going to matter. You probably don't remember that in 2011, the market dropped 20% in 10 days. You probably don't remember that in the beginning of 2018, the market dropped 12% right out of the gate. And hopefully, what happened in the last quarter of 2018 won't be important to you 6 months from now. Now, what if you're already retired? Excuse me. There's still plenty you can do. If you feel like you're too aggressive with your investments, give me a call. Now, keep in mind that I monitor this throughout the year, and if I feel that your investments are too aggressive, I'm going to reach out to you and be proactive. But that doesn't mean, I don't know how you're feeling. I don't know what's going on in your life. And if you've got concerns about being too aggressive, give me a call and we'll look at it and we'll get perspective and we'll make some decisions. If you feel like you might be withdrawing too much money, that's another reason why you might want to give me a call and we can talk about it. Again, that's something that I monitor throughout the year, but we can look at that and make changes if needed. One client, he was afraid that he was taking out too much money from his accounts, and his withdrawal rate was high, but we looked at the portfolio, revisited his plan and reminded him that he's going to be taking Social Security out in a couple of years. And that at that point, he'd be able to really cut back on his withdrawals and it would be fine. And another client, she was taking out too much. She had some reverses due to family situation, and she had to take out big lump sums of money. And as a result, her percentage withdrawal rate was a little bit high. It was $1,000 a month too high. So what we did was worked out a plan where in the first quarter, we cut it back by $250 a month. And then we revisited it and worked, over after a year and a half, we got her back on track, and it's not a problem. Now, you might be saying, you know what, Neal, my withdrawal rate last year was great, but because the market dropped, my withdrawal rate is too high. For example, let's say you're taking out 4% of your account. So if you have $100,000, you're taking out $4,000 a year. So, and then so you took out 4,000, and then the market dropped by 6. So so then you're down by 10% or $10,000. And you say to yourself, well, if that continues, I'm going to be broke in 10 years. Well, the thing is, you've got to, you've got to look at this a little bit more broadly. That, in 2017, you probably made a lot more than you withdrew. And the year before that, you probably made more than you withdrew. And the year before that, you probably made more than you withdrew. So the portfolios that I designed for you are designed with that in mind, that there will be years where we're taking money out and the account loses value. And of course, there's no guarantee of the future. But if we think about the long term for income, as long as we, talk and regulate and adjust, chances are pretty good that you're not going to have a problem. But we've got to keep the communication going and adjust as we go. And that's why I reach out frequently, to make sure that you're still on track. Okay, so let's summarize what we've learned. The economy is likely to slow down, but the odds of having a recession are pretty low. That could change, but according to the data right now, that's the way it looks. Interest rates may go up, but they may not go up as much as the Federal Reserve has said they will. Trade policy will be very important. Things could get worse before they get better, but there's plenty of reasons to be optimistic on this front. Logic tells us that they should be able to find compromise. Both the governments of our government and China. We'll have to wait and see, but there's already some optimistic movement toward an agreement. So I'm optimistic there. Now, you have no control over a recession, interest rates, trade agreements. But you do have control over something far more important, which is yourself. More than anything else, your attitude and your willingness to stick to your plan are going to determine your success. And that's what I'm here to help you with. And that's why, I consider myself your secret weapon that I hope you take advantage of. So with that in mind, I want to talk just for a few minutes. We have a little bit of time left about my approach. So I look at the market, the economy, and individual holdings, of course. By doing that, I can reduce some risk, but not all. Let me show you why holding on and not being, so quick to exit markets at the first sign of trouble is really, I think, in your best interest. Let me show you some proof of why that is, at least in the past. 2011, Standard & Poor's downgraded the United States government, first time ever. And the market dropped 20% in 10 days. Things looked really, really bad. And one client who's very educated, especially with respect to economics, thought that this was going to be the end of the world. And for good reason. I mean, if the United States government gets downgraded, that's a pretty horrific development. But the economy still looked pretty good. And the government had not yet defaulted. And it turns out the government didn't default. We talked it through anyway, and this person could not sleep at night. So we had a compromise, and we sold off 10% of the account with an agreement to revisit it every 10 days. And we did, and things started looking a little bit better, and the client felt a lot better and was able to sort of hold on until the market righted itself. And it's not a guarantee that will happen every time, of course. But, he could have sold at the very bottom and locked in a drop of 20%, or as it happened, the market pretty much was flat for the year, and he did much better as a result of talking to me, getting some perspective, and not being extreme. And this is a case where it made sense not to, just look at the market and make a decision. Okay, the next year, 2012, the market had big drops twice. China was one fear then, was slowing down, and also Europe. So in the beginning of the year, the market dropped 15%, and toward the end of the year, the market dropped 10%. And let's face it, if you were selling based on just the market, where would you sell? At the bottom of that arrow. And if you were selling, and then when would you start feeling, oh, the market's probably okay, I'll buy back in? Probably up toward the top. And then if you were going to sell again based on the market, oops, I'm wrong. Down toward the bottom here. That's so in other words, even though the market for 2012 went up by 14%, a person who just looks at the market or just makes investment decisions based on if the market's doing well or not would have locked in a 25% loss. So again, that's not the way it works all the time. But this is why I'm saying you can't just look at big moves in the market alone to govern your investment decisions. It can be extremely expensive. You have to look at the bigger picture. So I look at the market and the economy and the individual holdings, and that leads to infrequent trading, and that has proven over many years to do much better, have a much better result for you. And the risk management that I do is done by allocation between fixed income and stocks. And of course, I make changes in your holdings over time depending on the performance. That takes advantage of long-term trends. Of course, I look at your own situation also to make changes. And I believe that that's the best approach for you and me. My money is invested exactly as your money is. So I want to take just a couple of more minutes and look at my approach for you, to you. So what I believe you get from me, and I think there aren't many other people out there who provide it, is dedication. I give you personal attention. If you need something, we talk about it. usually within a couple of days. I take your success personally. My goal is so that you can enjoy your life and not worry about your finances. And I have a dedicated team that is also professional and fully committed to giving you world-class service that you deserve. Next thing is I have 30 years experience. I've seen what works and what doesn't work. And I have a vast database of experiences. So you get the benefit of that experience without having to pay for the mistakes. And I think that that has a great value. In financial planning, I'm a big believer, as you all know. So money is like having a car chassis and an engine, but financial planning is like the steering wheel. You need to have both, otherwise you're not going to get anywhere. So I'm a big believer in financial planning, and that's why I encourage you to update your plan with me, keep me in, up to speed with what's going on with you. It's not just about the money, but it's about your plan to achieve what's most important to you in your life. That's my view of things. And finally, I have a unique, I provide an approach that's unique and specific to you. You have a unique portfolio and a unique plan that's specific to your own financial situation that should help you, have the growth you need and the sleep at night you need as well. That's my goal. So before we end, I'm going to provide a little commercial. If you feel like I've helped you with your financial planning, making financial decisions, making investment, managing your assets, I wonder if you would be willing to help me. I'm hoping that during this year, you'll introduce me. It doesn't matter where these people are, but if you've got friends or relatives that you think would benefit by talking to me, I'm asking you to introduce me to 2 people who you think would benefit by talking. It doesn't mean that they'll sign up. It doesn't mean that I'll necessarily be able to help them, but if you think I can be useful, I just want to talk to them because I really want to help other people. And yes, some of those will turn into clients, others won't. That's fine. So I'm hoping that you'll agree to do that. Okay, so thanks again. It's an honor to be of service to you. If there's a way for me to be of more value, I hope you let me know. And email me with any questions or call the office and set up a time and we'll talk, or we'll get together in the office. And I look forward to being on your team for years and years to come. Thank you very much.